Hello everybody, welcome to TraderMerlin Show. It is your Monday edition, an all-time high Monday, which seems like pretty much every other day. It's all-time high days out here for us. Hope you were involved with some of that nice upside move. We're going to talk about the moves in the market today. Maybe a little bit later on, I want to get things started with the topic du jour, which is going to be really the B.E.C.C report. It's bonds, equities, currencies, and commodities, and there's a justification for that report to be done on a monthly basis. Our guest is none other than the almighty Mr. Scott McCormick. Scott, how you doing?
Doing well, Marilyn. How are you today?
The almighty, right?
I enjoy all of your introductions because they're always so creative.
The beauty of improv and no script. I don't want you to come across like the Wizard of Oz, but yes, glad to have you with us finally on this program. I know you're so busy. I appreciate you taking some time out of your schedule to come on today.
It's always fun to be with you.
Let's start things off. Since our viewers, we may have a different set of viewers here than we did on Power Trading Radio, I ask all first-timers on the program to answer 3 simple questions. I call it the trader's profile to give us a little bit of an idea of who we're dealing with today. So those 3 questions are pretty simple. It's how long have you been trading? What instruments do you trade? And what would you say is your trading style?
Sure. So I actually started off in the brokerage industry back in May of 2000. So this is about my 20th year it is the 20th year for me. As far as specialties, my focus has always been equities, options on equities. And, during my time with Schwab, like the first 4 years or so, basically I was a registered representative. So if you called, I executed whatever order you wanted. And it didn't matter if it was stocks, bonds, options, mutual funds, money markets, CDs, whatever. If it had a ticker symbol on it and Schwab traded it, I pretty much executed the orders. 2006, I actually became a registered investment advisor representative, and so financial consultant out of the Tyson's Corner office there, just outside of Washington, D.C. And so for about 3 years or so, from the summer of 2006 until about the fall of 2009, I worked with high net worth clients and helping them to build out portfolios, whether they were equities, mutual funds, combination thereof. So typically it was your generic kind of balanced portfolio, but I was really kind of responsible for helping to determine which type and giving recommendations as to specific types of investments to put in there. I left there in September of 2009, and it was at that point in time that I became an independent trader. So when I left, my focus was directional trading of options, and that was really kind of my forte, my bread and butter. But over the years, I have traded spot forex actively for myself. Again, options. But since about 2012, I've also integrated trading equity index futures along with certain commodity futures like gold, crude oil, and some currency futures as well, such as the euro, the yen. Mostly as far as style is concerned, on the equity side, it was primarily longer term, average hold time around 9 months. But for options trading, I found that my average hold time was right around 2 to 3 days. Sometimes a little bit longer, just depended on the market conditions. In terms of futures, though, definitely intraday for me, especially over the course of the last 4 years, where somebody can send out a tweet and change the direction of the market. I've found that this is really kind of my comfort zone. So yeah, that's pretty much me in a nutshell.
Nice. I'll summarize it for everyone out there. Scott loves the devils in the details, that's for sure. 20 plus years, trades just about everything. I think it all depends on what is being, the soup du jour, if you will, with regards to market activity. When he's looking at longer term, portfolio stuff, 9 months-ish. Futures, definitely intraday. Options, maybe a couple of days. So when you look at trying to pigeonhole Scott into a specific asset class or a style, it's not going to happen. He's pretty much trading everything, and I think that that's the beauty of what Scott brings to the table is that diversity and understanding of asset classes, styles, and then really, as I mentioned in the write-up for this show, was kind of the relationship between each of these individual components, because you could focus just on futures or just on equities or just on options, and while there is certainly opportunities in those by themselves, there tends to be a synergistic blend when you start to look at all of them together and how one impacts the other. It's actually a great question we got regarding the euro dollar, which we'll get to a little bit later on. But I want you to tell us a little bit about the B.E.C.C report, because this is something that I'm going to continue to just keep pushing you, because I know ultimately you're going to want to do this thing. I know you do. But this is something that I would subscribe to if you were doing it. Talk to us about the B.E.C.C report, what it is, and maybe we can start to look at some charts here and get a sense as to what it's showing us right now.
Sure. So the B.E.C.C report stands for Bonds, Equities, Commodities, and Currencies. And it was funny because I got the name almost from Bloomberg Radio, because on my way into the office every day, I used to listen to Bloomberg Radio, and they always talked about equities, bonds, commodities, and currencies. And I was like, you just kind of switch one letter and you got a nice little initialism or an acronym there. But actually, the genesis of it came about in the summer of 2007, because at the time, again, I was living and working in the Washington, D.C. area, and I was a member of a group out of Rockville, Maryland, called the Society of Market Technicians. And we always met the first Thursday of every month. And it just so happened that it was that Thursday of, the first Thursday in June 2007, that there was a really big move in the equity markets. There was a huge move in the VIX. And I just knew that the members of the meeting group, they were going to ask me, because what did they know about me? They knew that I worked at Charles Schwab. So they thought that, oh, okay, this guy's a broker, so he's got to be in the know. The other thing that they knew about me was that I was going through the CMT, which is the Charter Market Technician program. And so really studying technical analysis and intermarket relationships and all of these things that they just they weren't as familiar with as what I was at the time. So that afternoon, I decided to go through. I marked up charts for the Dow, the S&P, the NASDAQ, the Russell, and the VIX. And I put them into a manila envelope and I brought them with me to the meeting. And lo and behold, about 30 minutes before the meeting was over, the president of the group turned to me and said, Scott, do you have any comments about today? I was like, well, as a matter of fact, I came prepared for that. So I passed around the envelope and, just started to provide some commentary around the charts and what was happening in the markets at that time. And at the end of the meeting, the president approached me and said, hey, would you mind doing this every month? I was like, sure, no problem. Now, when I started doing this, I was like, okay, well, how do I approach this? Who's my audience? And primarily, a majority of that group were self-directed investors. Some were a little bit more active in the markets, but I knew a majority of them were really kind of long-term. So I took the approach of what I was learning in the CMT, which was that there are relationships between the various asset classes, but there was also a cyclicality and a rotation in the asset classes. There was a rotation, obviously, in sectors. And so I started to think about, okay, well, what most people would want to know is, should I be in bonds or stocks? What's going on in the commodity and currency markets? In terms of the stock market, where are the opportunities at, right? So I started to kind of put these things together over the span of the next few months, and ultimately it became known as the B.E.C.C report, because every month I would go through and talk about the strength in bonds and stocks and commodities to try and get a sense as to where we are in the economic cycle. And then I would use the sector performance to determine whether or not there's kind of a confluence or a confirmation between the asset class rotation that we're seeing and where we might be in the economic cycle, and then the sector rotation and where that kind of also relates, and try to see, are we in, for instance, like a stage 3 expansion, or possibly moving into a stage 6 contraction. And with that, what should happen next, right? Right. And that's always kind of a big thing about the markets. It's like you have to ask yourself the question, what should happen? It doesn't mean that it will, but you have to kind of speak in terms that are not absolutes. I can't look at a sector rotation and say, well, this is going to happen next. I have absolutely no idea. All I can do is formulate that idea or a thesis that this is what should happen based on the information that I'm aware of right now. And to confirm that thesis, this is what I should see. But if I see, a different scenario, then this is the one that's more likely playing out. And so what it really allowed me to do over the years now, because we're talking about 13 years that I've been doing this, and what it's really allowed me to do is kind of get rid of the noise that a lot of people look at, okay, or that they hear. Because you turn on CNBC or Fox Business News or even Bloomberg, you get the talking heads on there. They're there to promote their ideas. And sometimes their ideas are going to confirm what I'm seeing in the market. Other times they're not. And if what I'm seeing is not congruent with what they're saying, then I need to kind of stand up, pay a little bit more attention, maybe judge their work a little bit more, or go through and just double check mine. But what I found is that it's allowed me to not just anticipate some of the bigger cycles inside of the marketplace, but remain bullish when I should be, or make me a little bit more cautious when I should be inside of the marketplace. And I think what's important for your listeners to understand is that these cycles, they play out over the span of years, right? Which is part of the reason why I do this on a month-to-month basis. So, whenever I conduct this analysis, I'm always looking at monthly and weekly charts. So, for instance, like today, we had a very strong open at the market, only to see it kind of fade away, and then we regained by the afternoon, right? Right. And so, one of the principles that I always apply inside of my analysis is trend analysis of each of the products, and understanding that not only do we have those three directions, but we also have the two phases. If I know that I'm in an uptrend and I'm impulsing, kind of like what we did this morning with the equity index futures, then I know there's a correction that's coming. But that correction isn't necessarily a place for me to go short. I might be able to as a day trader, but really I should be standing on the sidelines waiting for it to come back to an area that is a better buying opportunity for me, because I know the overall trend is up. And so I apply those same principles to longer term. So for instance, going back into the spring of this year, from a macro perspective, it was a massive buying opportunity for equities. And I know it's easy to say that now, looking back over the last 5 months or so. But when you stand back and you take a look at where the sectors were, certain leading sectors inside of the S&P were at that time, when you take a look at the monthly charts on a lot of the equity indexes, it was just simply a correction within the context of the big picture. Could that have changed, and could it turn into a full-on bear market? Absolutely. But that's where watching the shorter-term price action as it relates to the long-term price action becomes important.
Yeah, I got the charts up here of that big old sell-off, and I think it's interesting you said right now that the Beck report is really kind of there to help you understand what you should be doing right now. And if we look at this, we're seeing some very interesting things, and obviously we can go into the microscopic details as the show progresses, but you're at all-time highs right now. We broke through it today. Certainly that end of the market, which a lot of people are calling the Fed bump, pushing up the market the last hour, seems to be with regularity. Big move to the upside in the last hour of the market, puts it to all-time highs, intraday closing, etc. When I look at the equity indexes, it's telling me that I should be long at this point. When I look at the commodity side of things, though, it paints a different picture for me. I'm not going to sway you with my thoughts on it, but how does this break down for you now? When you say it should be what we should be doing, how does that translate to you for right now for these markets? What should we be doing?
Sure. So, when we stand back and we take a look at, the asset class rotation, because now you're talking about commodities and stocks, right? So now we're getting into specific asset classes. And so it would be important for your listeners to understand that, generally speaking, as you go throughout an economic cycle, what you would expect to see first is that, let's say, for instance, we've gone into a downturn, right? Let's say that we've gone into a recession. What should happen? Well, what should happen is that your bond prices actually bottom out first and start to go up as the Federal Reserve is actually lowering interest rates. And we've seen that, right? I mean, if you go through and you take a look at a chart of the 30-year or the 10-year, we've seen nothing but up over the course of the last few months. Now, with that, we would expect that eventually we get a bottom inside of the stock market, because those actions that the Federal Reserve or your central banks globally are taking should provide a bottom of some sort and some stability, not only to the stock market, but to the economy. Because yes, we would expect to see that there's some sort of a reaction to the stock market due to the Fed's actions, but those have real fundamental impacts on the overall economy and how it's to how those actions are actually supporting businesses and in their operations and so forth. Now, the commodity side of thing, what we should see is that if we've gone into a recession, right, and we start to see some stabilization, the commodity side of things is really going to start to show that we actually have physical demand or demand for those physical items coming back into the marketplace. Why would that be? Well, that would be because we're manufacturing more of those goods that require things such as your metals to go into those final products, right? Yep. And then, of course, we can get into the conversation about looking at the transport indexes to see, are those actually improving, to kind of get a sense as to whether or not those goods that are being produced, they're not just sitting in a warehouse somewhere collecting dust, they're actually being shipped out. And so as we look at things, we might not see the recovery inside of commodities just yet. But over the span of the next 3 to 6 months, what would we actually see? Obviously, this summer we've had a significant rally within the price of gold. And again, looking at the monthly charts, one of the things that I like to do is not just pay attention to trend, but I also pay attention to the phase of the trend, whether it's an impulse or a correction. An impulse simply being that move that goes with the trend and the correction going in the opposite direction. But being able to define those also allows me to complete what are referred to as just a simple measured move. Mm-hmm. And so, if a previous move went 100 points, then the next move might go 100 points. It's a very simple principle. But when we take a look at the last real impulse in the terms of the monthly chart, that was from the lows of October 2008 to the highs of October 2011. And so if we were to project that same distance from the lows of 2015, where the most recent kind of bigger term correction had bottomed out, that actually forecasts gold to rally upwards of around $2,200, almost $2,300 actually. So it's $2,290 is the target. Now with that, compared to where we are right now, I mean that's another 300 points almost from where we're sitting today, right? And then you say, okay, well, that's gold, right? That's just a hedge against inflation. Not necessarily. Gold is also used, within computers and the manufacturing of computers. It's in a lot of different components. But another very popular physical metal that is used in construction and in electronics, I mean, it's everywhere. It's copper. Oh, sorry about that.
No worries.
Copper has actually been doing fairly well here since the spring. It's been extremely strong. And it is in a bit of a wider range between the lows in 2015 and the highs there in 2018. But the interesting thing is that from a macro perspective, and again, I'm looking over the span of the last 20 years here. If you look at the last major impulse that we had, it was the reaction from the lows in December of 2008 to the highs of 2011. So right there in the first quarter around February. Now, the corrective low that I would measure from is there in the spring of 2016. So the forecast on that would actually send copper up to about 532 for the price of copper, right? That's quite a move from where we are today. Not quite a double, but the old adage there is that copper puts a ceiling on the economy, it also puts a floor underneath it. Right.
Yep.
So when we take a look at these things, again, looking at it from more of a macro perspective to see, where are the opportunities? Okay. So in the short term, copper could get back up to, that 314 to 315 area and kind of top out or base around for a little bit. The question is, what does it do from there? Right. Because if it does move through that 315 area, I'm going to say that that's a pretty critical space. And initially, you do have some resistance up around that $4 spot. But if it does have the same magnitude move as it did before in 2009 to 11, then I would expect to see it go up to 532. Now, a lot of people would say, well, what do you think the catalyst is going to be on that? I have absolutely no idea. Right? That's not my job. That's the job of the economist. Right? My job as a technical analyst is to look at the market, see what it's done before, and kind of think about what are the possibilities. Now, again, could that be wrong? Could everything collapse? Sure. Which kind of takes me to one of my favorite quotes that a mentor of mine gave me early on, which was, the only thing you're ever going to know is where you're wrong.
Yep.
And so that's part of the other reason why I like to go through and do this on a regular basis, because as I review the information, either the information is confirming my original thesis, or it's actually counter to that, and I have to force myself to go back and actually reevaluate and see if is there anything that I've missed? Is there anything that's changing that is going to change this forecast?
Yeah, I'm trying to map out as you were talking on that on the copper chart here. Pretty cool. These big picture types of moves. Obviously, you look at what's happened with copper, and you guys can see it on the screen here. It's done just like every other asset class during this bounce since March, which has just gone absolutely straight up. I mean, you're almost up 50% gain in copper in that same period of time, which is a remarkable move. That said, there's still a ton of upside potential if you feel that those types of waves and moves are going to come back again. With this type of thing, are you looking? I mean, how do you play this copper thing if you're expecting to get up above that $5 mark, or even getting to $5? That's a huge price move, especially with the leverage you get from the futures product. So are you actively looking for that big move like that, or is it just kind of chipping away at it as it moves up?
Well, if you're trading copper outright, I mean, obviously you would have to go and take a look at some of the longer term expirations that are available there, and you start to get into the premiums and the discounts that are available versus where we're currently trading if you're going into the futures market. The other thing that you could obviously do is start to go out and look at various material companies that actually physically mine copper, because most often you'll find that there are stocks that actually have a very high correlation to the price of those products that they mine, whether it be gold or silver or in this case copper. So it requires a little bit of homework, but obviously it's pretty simple today. In most trading platforms, you can run some sort of a scan to help you find those material stocks. There's one off the top of my head, which is Freeport-McMoRan, which is a pretty common copper stock. And if you take a look at Freeport-McMoRan, you can see that monthly chart has a very high correlation to the price of copper. And when you take a look at where that forecasted move would be, that could potentially take that stock from where it's currently trading about $14 upwards of at least, I'm not going to say it's going to make another all-time high versus its 2011 move, but I wouldn't be surprised to see it get back up there around that $59 or $55 to $59 area. So, and versus where we are today, I mean, that's still a pretty significant move.
Sure.
Now,
yeah. And just for the viewers at home, you can see, and this is kind of the important piece that Scott was talking about. You look at the top chart here, we have copper's continuous contract on a monthly. Down below, I've got Freeport-McMoRan, and you can see that definitely Freeport-McMoRan is pretty lockstep with that price of copper. Obviously, Freeport isn't just copper, but certainly the potential. So, I getting to your answer to my question, which was, how do you play this? Maybe you don't have enough capital to get into the futures contract or hold it that long and keep rolling month after month. Freeport-McMoRan or some others. There are other companies out there like Rio Tinto off the top of my head. And then you have Southern Copper Corporation, BHP. Those are all kind of big copper mining stocks that should also benefit from an upside move in the price of copper. There you go.
Exactly. And that is, obviously a safer way to play that over the long run. If you were to take a look at some of those stocks, you might be able to find that some also pay a dividend. Most of these would actually offer various options to where you could do calendar spreads on these to try and generate additional return on your investment while you're waiting for those longer term moves. Now, again, you get into situations like that, then you always run the risk of being called out away from your position, but you can always get back in. And I'd certainly, I don't want any of your listeners right now to say, well, he said Freeport-McMoRan, let me go out and buy it right now.
Right.
Yeah, you have to be tactical about your entry on this, because when you start to take a look at where we are in Freeport-McMoRan, would I buy it right this instant? No, I probably wouldn't. What I would probably look to do is try and get some sort of a retracement coming back down to a support or a demand area, giving us an opportunity to join that trend. If you're willing to take a breakout and place a stop below a more recent swing low, that's another tactic, but you're Position sizing might have to be a little bit smaller in order to control the risk inside of that position.
Right. Yeah. It's up over 200% in 6 months. So yeah, it's a little extended.
Yeah.
Scott, let me go into some listener questions here that I always try to answer as many of them as I can. Let's see. There was one that came in I want to make sure we get to that dealt with the dollar. This is from Larry, who is actually here with us today. Good to see you, Larry. The question is, I'm trading the currencies, FX, Euro USD on the daily time frame. If I want to see the direction of the dollar, should I look at the S&P, the SPY, the Dixie, the VIX, so that I can see how many pairs are, what my pairs are doing, and what time frame for the dollar? Hourly, 15-minute, daily. So I guess it's really more of how are you maybe potentially tracking the dollar, and how would you use that information?
Sure. So when, obviously currencies are part of the Beck report. That's one of the last things that I look at in terms of portfolio management. Now, if you are trading spot Forex or even some of the currency futures outright, not as a hedge, but as a directional play, then you, especially if you're entering in off of the daily charts, you really should be looking at this from a longer term perspective, meaning to have the right perspective, you should be using your weekly and your monthly charts and have it in a way to where you can see, the last 10 to 15 years worth of data, possibly 10, 20 years worth of data. Now, having said that, what I would like to mention or remind everybody of is that when you look at the dollar index, there are 6 primary currencies that are in there. And the top 3 in order by weighting are the euro, the Japanese yen, and the British pound. And of those 3, they actually make up roughly 87% of the dollar index, which is why those are the 3 currencies that I look at. Because if I'm trying to get a sense as to where the dollar is going to go, then I'll look at those 3. And more importantly, the euro US dollar. And the reason why is because the euro US dollar actually represents about 57% of the dollar index. Mm-hmm. Now, that said, if you know that the euro US dollar is 57% of the dollar index, it's almost a complete mirror image. So there are times, though, where you'll have support and resistance areas inside of the dollar that could actually foretell turns that take place inside of the euro US dollar. But for the most part, you're going to find that those same support and resistance areas for the euro US dollar coincide with the ones inside of the dollar index itself. Mm-hmm. Now, would I go to look at other assets like the S&P 500 to see, is there some sort of a correlation there? You could, and at times there have been. I mean, there have literally been times where if the S&P 500 is going up, the euro is going up. If the S&P was going down, the euro was going down. But those relationships change. And so it would be more important to go through and actually conduct a correlation analysis to determine what that correlation coefficient is. And, because those things change from day to day, week to week, month to month. And if the relationship isn't there, then leave it alone. Don't force it, right? Yep. Now, for me personally, when it comes to correlations, they really are kind of a tertiary decision-making tool for me. I mean, if I see it, then I'll try to exploit it. But if it's not there, I'm not going to go looking for it, if that makes sense. And I know that might make me sound a little more naive, but at the end of the day, we have to remember that correlation does not mean causation, right? And with that, I have to also understand that if I use a different product to tell me that the one that I'm actually going to trade outright is going to turn, I have to see that the price is actually turning in the product that I'm trading to confirm that. And at the end of the day, my profitability is based on the price of the product that I'm trading, not necessarily the item that's correlated to it. So as I go forward, again, the only thing you're ever going to know is where you're wrong. But one of the other things that I live by is that price is king. Yep. If you're going with it, you'll make money. If you're going against it, you're going to lose money. So if you determine that you have a place that's safe to enter and you've identified a safe place to have that stop and you have the right position size, then hold on to it. If you get stopped out, you get stopped out. That's the market's way of telling you that you're wrong for now. Mm-hmm. To step back and actually reevaluate that situation. And
Scott, in part of the analysis you did, and congrats on the CMT. For those that don't know, CMT is a pretty prestigious thing to get. Just basically means he's a super nerd and knows the markets very, very good. I actually have all the books over here, but I don't think my brain capacity could handle that kind of information.
I'm sure it can.
These types of relationships that you look at, and I think that it's a point I really want to drive home is, there's an old adage that says, if it ain't broke, don't fix it. And if I'm correct, I'm assuming that part of your analysis says, historically, this relationship to this one has been X, and therefore I'm going to use that going forward, as there should be a high probability of that continuing because I've seen it over the course of time. For example, a very weak dollar. A very weak dollar is generally associated with a bullish phase in the equity markets. It's a sign of more of our goods and services be sold. Right now, we're not seeing that relationship at all, right? Right. I mean, it is. The dollar has been tanking recently, but it has been disconnected. So, are those types of relationships that you're looking for to be broken in your Beck report, like that dollar index? What I'm talking about with the markets. That's if you got a real weak dollar, we should see the markets rallying. We're not. Same thing like oil right now is a great example. Dollar's tanking, oil's completely flatlined, where it should be rocking because obviously a cheap dollar makes oil more consumable, right?
Yes, I'm sorry. So generally speaking, whenever you are looking at like a strong dollar, weak dollar, it can make our goods and services a little bit more affordable, less affordable in terms of trade, right?
Right.
The other thing that I pay attention to, like you said, is that those relationships, they come and go. So if I see that they're disconnected, then I do note that. And I will pay attention to any types of changes to see if there is an influence. But if there's not the influence, then it's not something that I'm going to dwell upon. One of the easy trades going back into the last decade, so 2002. I'm going to have to start speaking in longer terms. So the last 2 decades. So going back into 2000 through 2010, one of the common relationships was that stock market up, bond market down. Stock market down, bond market up.
Right.
But today, it's kind of gone back to the way it used to be. Stock market up, bond market up. And actually, it's bond market first, stock market second. So, as I look at these, and again, if I see those relationships, then it'll get my attention, and I'll just act accordingly, if you will. But seeing that breakdown, is there concern on my part about like what the stock market is going to do? Not necessarily. I mean, if we see that the stock or the dollar index is breaking down, and then we start to see that bonds are kind of breaking down, then I would expect to see that the stock market breaks down. But right now, the bond market itself, and actually one of the things that I was double checking before we got started here today, going back to our measured moves, the 30-year and the 10-year Treasury have actually completed a measured move versus their last major rally, which was from the lows there in 2013 to the highs in 2016. And so, I wouldn't be surprised to see if the bond market starts to move into a corrective phase and on the 30-year at least maybe comes back down to around that 155, 160 area. But with that, if that were to occur, is there the possibility that the stock market could come down as well? The answer, of course, is yes. But the other piece is that if the stock market comes down, is that simply a corrective phase, or are we actually entering into a bear market? Mm-hmm. And because those are two different things. I know for a lot of people, and obviously I'm sensitive to this. A lot of people took a big hit in that sell-off from February to March. And, when we stand back and look at that, though, even though that price decline was in terms of points in the S&P 500, the same distance as when it fell in 2008 through 2009, not the same percentages, but the same dollar amount, it's not a bear market, right? It was simply a correction. Now, if we start to see closes below that low from March, then yes, I would say that we're probably moving into a bit of a bear market. And I would say, I'll put this out there, am I concerned about the way that the S&P 500 looks on the monthly chart? Absolutely. And the reason why is because when you start to look at this is what's becoming to look like an expanding top.
Yep.
And with that, what that means is that you're getting higher highs, but you're also getting lower lows. And for your listeners, If they don't know what a feedback loop is, kind of think of it in terms of going to a concert and just getting that microphone too close to the speaker. It just gets louder and louder and louder as that feedback loop continues. And so my concern is right now, and seeing this in a number of the indexes. I mean, we see it in the S&P, we see it in the Dow, we see it in the Russell. My concern is that volatility continues to increase. And what we see is the easiness of investing, if you will, like what we had during the 13, 14, 15, and that 17, 18, early 19, that's gone. Because we've started to see now that there's so much more volatility, which means that from a longer term perspective, you're probably going to actually see more long-term buying opportunities, but those sell-offs are going to be pretty sharp and pretty quick. But you're also going to have to be pretty nimble about protecting the profits that you have, because with the S&P 500, if that's the proxy for all the stocks that are out there, we're probably going to see a bunch of stocks sell off but when the next sell-off takes place. But not all stocks look like the S&P 500 either.
Right.
So if you can actually find some of those stocks that are that look a little bit different, right? They didn't make the lows in March versus their lows in 2019. Those are those stronger stocks that, yes, even though we might see some short-term weakness, from that longer-term perspective, they tend to be safer buying opportunities.
So much to think about, man. I got questions flowing out my ears over here, but I don't want to keep you for like a full 2-hour show. Well, it's interesting because I think in the years I've been doing this, we're in a totally different, I guess, market dynamic. It used to be that the Fed was there to slowly interject in the markets and steer it. Now, to me, what the Fed has done is essentially, it feels like I'm at that ride at Disneyland where you're on the car. I remember this ride vividly. I can't remember the name, but it's like this cool car. You get in with your parents. It's just for kids, and you get to sit in the driver's seat as a kid, and you turn that little steering wheel, and you're going down that track. But you come to realize it's a 6-inch high concrete track between your tires, so you can only go that direction. And I feel at this point, we have a situation where the Fed is just laying down that concrete track, and we can only go up. I mean, it just keeps trucking and trucking and trucking and trucking. So I think it's definitely a different market dynamic, but I do agree with you. I think we're going to see real volatile swings. I think when the next big drop happens, it's going to be one of those ones much akin to what we saw in February, where unless you're glued to your screen and seeing it as it happens, you're going to miss it by 3, 4, 5 days as it just has a really sharp aggressive fall of 10, 15% like we saw, and then it'll probably right back. Yeah, Cartopia, that's the one. Thanks, Big Ev. But that's just kind of the new normal that we have to deal with, and I think that there's plenty of opportunity out there. I do think that these relationships are pretty important to follow. I've always loved your analysis of copper over the years. It's been one of my favorites. Let's see. I got questions out the wazoo for you, but I'm only going to go through a few of them here. PBJ wants to know about the CMT certification. How did you obtain that? Just Cliff Note version of how long it took and what does it entail?
So the program is very different today versus when I went through it. Keep in mind I started back in 2001, and I finally earned the designation in 2008. There are 3 exams that you have to successfully pass. Along with that, you have to submit your technical analysis work to be reviewed by other CMT designation holders, many of which will be glad to volunteer to review your work and be a sponsor to recommend you as a CMT. Double check with the CMT Association in terms of what the requirements are today, because again, I believe they're very different than when I entered the program. I know that at the time they required that you were in the industry in some regard. So if you're a licensed representative somehow within the banking or finance industry, then you'll be able to carry that designation. Now, in terms of value of the curriculum, I think that even if you didn't want to pursue the designation itself, but if you wanted to be an affiliate and you wanted to, study the material, test yourself, attend the weekly meetings that they have online or go to the symposiums that they typically have on an annual basis, I would absolutely say that it's worth it. I mean, there's a great deal of information that I've been able to assimilate into my regular routine, some of which is actually seen inside of the Beck report. But go to the CMT Association website and check it out. They'll be more than happy to talk to you about the details.
All right. Don says all this bearish talk. I think you just joined late, buddy. I wouldn't call it bearish talk.
No.
Actually, I think Scott is more on the bullish side just because the market's that's what the trend is telling you to do. I mean, it's funny, Scott. Someone sent a joke to me the other day, and it was humorous, but it almost has a touch of realism to it. If you look at the SPY, all right, I'll bring up SPYs up here on the chart, guys. You can see it right now trading at 342.90. It's called the S&P 500. So now I saw this meme, and it says market makers knowing that it's called the S&P 500, pushing it to 500. I mean, it's kind of funny to think the S&P at 5,000, which it will get to eventually. There's no doubt in my mind. It's just a question of when. I don't think it'll happen in the next couple of years, guys. I think it's going to be a little bit longer than that. But do you believe that type of stuff? That's the magnetism towards these big price numbers, or when people start talking about down. They said S&P all-time highs. And I was like, okay, well, you're pretty much guaranteed to get there because it's like a Ouija board. But, how are you looking at this number like 4,000 on the S&P or 5,000? Does that ever play into your analysis?
Sure. And, it's like when I started, they talked about Dow 30,000 and it only took about 20 years to get there, but, it's gotten close. I think eventually it'll get there. Is it going to get there, in the next year or two? I don't know. I like to think of it in terms of percentage change. So if we were to take the S&P cash index, which is at 34 or 31, and compare to, ask ourselves the question, what size move would have to take place in order to get there? It's about a 46% increase versus where we are right now. And so have we ever seen a 46% increase in the value of the index? Well, if you take a look at the increase from the lows in March to where we are today, that was a 50% increase right there.
Right.
And that was within the span of 5 months. So is it possible
Absolutely.
That with the, just massive influx of money from your central banks going into the markets, is it possible that we'll actually see that? Yeah. And I wouldn't say that it's impossible, for us to get there. Improbable in the next year? I don't know. I would say that, there's probably maybe like a 30 to 40% chance that we would get there in the next year. I would say that it's more likely that we would see it in the next 3 to 4 years.
Yeah, agree.
But and that's kind of the funny thing. Obviously, I mean, if I said, we'll see it in 10 years. All right. Well, thanks for that on the dartboard. But my point is that, what's the likelihood of that actually happening? The probability of it actually happening compared to where we are right now. Because when I take a look at the market again, I see it through the lens of trend and phase, impulse and correction, trend up, down, or sideways. And what I see right now is that, the trend is up. And when we kind of compare this most recent upward swing in price, I mean, we're kind of getting up there.
Yep.
In terms of the distance that we've actually moved before. And so, would I be surprised to see a correction? No. And somebody will probably blame it on the election. But then with that, once that is kind of passed, I would think that we would actually see some sort of stability, or at least that kind of the unknown has become the known, and we just kind of go about our life. And that's kind of the thing about the markets, is that we can sit here and speculate all day long about what's going to happen in the future, but it doesn't mean that it's going to. So
Right.
You just have to pay attention to what's happening today. And how that's impacting you, and where that kind of fits within your overall investment theme, and how you need to change with it as it changes. That's the important part.
Right.
If you don't like to change, you probably shouldn't be in the market.
Probably shouldn't. Tell us a little bit about what you're up to. We're getting up here on time, and I didn't mean to keep you this long, but I always enjoy chatting with you. For those who don't know, Scott does stuff for Online Trading Academy. He does the daily market overview, which I would encourage you to check out. He's also part of the team that puts together the grid levels. So for those of you looking at the Mastermind Grid, he's one of a few that are building those levels out every day. How can our viewers kind of get in touch with you? Are you got regular classes going on?
Yeah, so my classes, because I've been so involved with the grid team and writing the daily market overview, that's really where my focus is. It's probably the coolest job ever because I kind of put it into some good terms for a family friend the other day. For OTA right now, I'm working about 2.5 to 3 hours a day. And what that entails is getting up at 4 in the morning. I live in Dallas. So I'll get up at 4 in the morning. I'm in front of the screens by 5:30. And over the span of the next, 2.5 hours, 2 hours, basically what I do is I go through and produce a portion of the grid, which basically entails me reviewing and identifying new supply and demand zones inside of the marketplace. So areas where we think that various products will turn. And those products include, your equities, your equity indexes, some of the sector ETFs, some of the commodity ETFs, bond ETFs. But then I also write the daily market overview. And for those of your listeners that aren't familiar with that, the daily market overview reviews 8 different futures markets, 4 of which are the equity indexes. And then we get into 2 international indexes. We also get into 2 currencies, popular ones, the euro and the yen. But we also, help our readers, prepare on a daily basis, making sure they're aware of what high impact as well as medium and low impact economic reports are coming out over the course of the next couple of days or the next 24 hours, depending upon, whether they're high impact. Are there any futures rollovers that are taking place? Are there, like last Friday, we had options expiration for August. So just all of those kind of important things that any market participant would need to know. We always post in there like the upcoming earnings for the next 5 business days. So this week we've got a bunch of retailers and some technology names that are coming out. So that's going to be some important information that, any market participant would need to know in order to prepare their day. And then after that's done, at about 10 to 7 my time, so I guess that's about 10 to 8 East Coast, I spend about the first 30 minutes of an hour and 10-minute session going through and just kind of reviewing the markets and kind of just giving them the highlights of the daily market overview. What's the trend? What's the phase? Are there any key areas that we need to be watching for the development of a new supply or demand zone? What are the current supply and demand zones and kind of the higher time frames to give them some context as to, should I be bullish or bearish on gold or the markets, et cetera. So,
nice. Is that available to all OTA students, or is that just Mastermind?
So Monday through Thursday is Mastermind exclusively, but on Fridays they open it up to XLT students. Okay. So there you go. Along with, of course, Mastermind. So the crowd is about twice as big at that point.
Of course. Yeah. There you go. Yep. Scott, thank you for coming on. I'm sorry it took so long to get you on the program, but I'm going to see if I can maybe get you on more frequently so we can dive deeper in some of these 4 markets. But love the analysis, love the back report. I'm waiting for the subscription service, so let me know when I can sign up for that one.
All right. Sounds good.
All right, Scott. Thank you so much. Take care.
All right. Thank you. You too.
Guys, that was Scott McCormick. I've been working with Scott for many, many years, and as you can see, he has a wealth of knowledge, and when he gets going on a topic, he can get going and going and going, but there's just so much great information in there. I hope you guys all appreciate that. Again, he mentioned he's doing the daily market overview. You can find him in Mastermind doing that one. Let's see. A question came through Don. This is a really good question from Don, and I think that this is kind of common in the industry, and this is why it's important to look and see who's the major holders. A lot of the IPO stuff is generally, not IPO, but a lot of the younger companies are generally very heavily owned by institutions. And I'm not sure the exact number, but I'll trust your numbers here, Don. He says Tesla's 40% owned by institutions. How do you think retail taking over or becoming a presence will change that? Obviously, it's going to drive it up because most retail investors are biased to the long side. And that's probably why you're seeing this acceleration being fueled to the upside. It would be interesting to go back and do a study. I don't have the time, but I know, Don, you're pretty darn good at this stuff. Maybe you could do one where you break down how the institutions have been offloading their position into momentum. So one of the things that institution needs to do is they need to create demand. Because if I'm an institution, I bought $100 million of Tesla stock pre-IPO as one of the original guys in there, I got $100 million worth of stock. I'm doing everything I can to pump that thing up, getting you to buy it, thinking that Tesla is going to dominate the world, so you want to buy it. And as it rallies up, I can peel off some of mine and make a profit. So the challenge is figuring out, how they're unloading it. Do they plan on holding what that current 40%, or will they be further selling off? Was it 60 a month ago? But this is the norm. You normally see younger companies, and Tesla's not exactly young, it's youngish. They still have a tremendous amount of institutional investment, and especially when something gets out of the S&P 500, then it becomes very heavily institutionally held. Now, that also will be great for Tesla's price, and of course, if you guys have been watching the chart of Tesla, as we have on this program, here is TSLA. It has been phenomenal. I mean, it's just been rocking to the upside. This week has been a little rough, but come on, we'll take a little bit of a pullback when you have such a move like we've had. I mean, it was 1,400 and we hit almost 20. Was it 22? Yeah, well, not 22, 21, 29. So that's a norm out there, Don. I mean, it's the heavier they are held by institutions, the more likely the purchasing by retail is going to push it up. Let's see, Abby. Does a 3 to 4 year guesstimate include a bear market? Sorry, Mike, I didn't get to that one. And I see a lot of you guys speculating about the November election. And I think that the challenge is this. It's just like my speculation that we were going to see a sell-off in the summertime, which did not happen at all. Matter of fact, it was the exact opposite of it. We'll always have those expectations. I personally think that there will be a correction going into the election. Who knows? It could be because this new comet that NASA discovered blasts into Earth, and that creates a big panic selling. But they say markets are never down in an election year. Yeah, I don't know if that statistic is actually true, but it's generally going to be up. We know that the institutions and administrations are going to try to keep that up so that they can get reelected. That said, I think there's a tremendous amount of uncertainty going into the election, and I don't care which side of the aisle you're on, whether you're pro-Biden, anti-Biden, pro-Trump, pro-anti-Trump, I don't really care. I think that ultimately we'll see a lot of increased volatility as it gets closer to the election day. Personally, I think you'll see more likely down days just because of that uncertainty going into the election. But you know what? I've been wrong many, many, many times, so I'm not too concerned. Let's see. What else we got? How do you know how much you can go into Yahoo Finance. Let me see if I can bring one up for you real quick. I'll bring up the page here, and generally this information that you're going to get there is going to be delayed. So we can go TSLA. There's your Tesla, and I'll bring it up here for you. Give me just a second. And then you can go into holders. So on the top page here, some's going to be more accurate than others. It's just to give you a ballpark idea of the major holders. So it's actually more. You've got 57.93% held by institutions, according to Yahoo. Of course, this is, again, going to be delayed reported information, but that's still quite a bit. And you'll notice that for a lot of big companies. Like, let's just see what Apple is. Apple is like one of the most popular retail stocks, but also it is in major indexes, so it's going to have some big institution. It's 62% held by institutions. So, it's still, I don't know what the average is, guys. I'll be honest. I don't know. But my guess is the average is going to be somewhere around 60% institutional holding. Let's see. Give me another ticker symbol. How about Amazon, right? That's a pretty popular one. AMZN. Okay, let's go look at that. Yeah, you're looking 57% on Amazon. How about Microsoft? So 74% held by institutions. So the institutions generally going to have the lion's share of it. But there you go. There was a question earlier about different mining stocks as well. Some of the main ones, guys, the four biggest ones I can think of are going to be Freeport-McMoRan, Southern Copper Corporation, Rio Tinto, and BHP. I'm sure there's plenty of others, but those are the ones that just come off the top of my head. Yeah, Tesla shows like 58% institutional. Yeah. Simply trade the charts, Abby. Yeah, you're right to simply trade the charts. You want to know what Cronus is? CRON? Is that what you're asking about, Fernando? If you want Cronus, I'll check out Cronus. That's the cannabis stock, right? Let's go up. Cronus Group. Almost no institutions. Check that one out. That's kind of weird. 17.5%. Okay, now what does that tell you? I mean, to me, that's actually a really bad sign, because if institutions aren't there, that means they don't have optimism for it going forward. Because if an institution thought it was going to go up, they'd already be there. Think of the institutions as the smart money. I know we all make fun of institutions and we hate institutions, but that's rather interesting. Let's see what some of the other cannabis companies look like. I thought it would be much higher than 17.5%. How about Canopy Growth, another popular one? Let's go to holders. 13%. So maybe it's just that they're not allowed to participate so much in such a controversial industry such as cannabis, but it looks like relatively no numbers. All right. Let me real quickly go through your economic calendar for tomorrow. I'm already way near the end of time. I'll see if I can get to a couple more questions here. The question that came through before I get to the economic calendar, this was from Larry. This question was great. He said, if I'm trading Euro USD on the daily time frame and I want to see what the direction of the dollar should look like, basically put a mirror at the bottom of your chart if you're looking at the Euro USD, and then you'll look at it, and that's what the dollar chart's going to look like. It's going to look almost identical, inverse relationship to the S&P. I like to use the dollar index just to scout levels for the S&P as well as for the euro. Remember, the euro is going to be pretty much the Rorschach, exact opposite of what you see on the Dixie chart. And generally, daily is where I would be starting my time frame analysis, and I'll go down to the 15 at the smallest, but that's just me. Yes, there was, Andrew, and this is similar. We saw that with a lot of .com stocks. Andrew, you guys see it in chat, so it seems like most of the weed stocks crashed, at least in Canada. Yes, same thing with the .com bubble in the 90s. I mean, there was a boom for almost everything. You just label yourself a weed company, and all of a sudden you're going through the roof. Then, all of a sudden, there is a sell-off when it comes back down to realization that these things are very overpriced. Then you get consolidation. Then you get that next move to the upside. And I believe now we're kind of in that consolidation phase. I haven't seen too many big deals going through, but I would imagine that you'll start to see some consolidation here within the industry, and then you get that next leg up and you get some of the bigger players will survive out of that one. All right, so I said economic calendar. Where am I at over here? I got too many screens going on. Here's what I got for the 25th. Ooh, yes. It's there was really nothing that impactful today. What is noteworthy for tomorrow is going to be down here near the bottom of the page or in the middle of the page. You have HPI numbers, which is home price index. You also have the Case-Shiller Composite 20 home price index, which I think is pretty important. We're still seeing nice gains, but they're expecting it to slow just a little bit. Now, the number that I'm kind of focusing on, even though it's the Richmond Manufacturing Index, it's 7 a.m. tomorrow, so that's going to be 30 minutes into the trading session. It won't be a major market mover, but remember, we had last week the Empire State miss their expectations, and we had the Philly Fed Manufacturing Index miss also. So that means that Richmond most likely will miss as well. That could put it negative. My guess is it'll probably show up between 1 and 5, somewhere in there. Let's see. The other important piece here, which is interesting, is the new home sales. If you guys saw the Monday Market Must-Knows I did for Online Trading Academy, this is a really important piece of data because the last time we saw more than 776,000 new homes sold was 13 years ago. It's a long time, and they're actually expecting a pretty big jump, and I believe that some of the smartest minds in the world work in the new home industry, the KB Homes and Toll Brothers. So if they're expecting these types of numbers, new home sales, you might want to keep an eye on Toll Brothers and KB Home and Lennar and things like that. So big number for tomorrow. That will be a market mover for sure. Also remember that 30-year right now, you're looking at about 3% for a 30-year fix. So definitely some damn good deals out there. All right, that's your economic calendar. Earnings-wise, we step it up a little bit tomorrow. We've got CRM or Salesforce. You've got Best Buy, who's had a remarkable run. Certainly a lot of people looking from the work-from-home environment. And Medtronic reporting earnings tomorrow. Viva Systems. There are a couple others, but those are some of the major ones reporting earnings tomorrow. All right, what else have I got? I've got a question. Oh boy, Investopedia economic calendar, Japanese yen forecast 130, actual 52. Okay, depends what we're forecasting here. You've got JYP. I don't know. You mean JPY, right? So what are you calculating out there for the JPY? If you look here, I think you're. Let me reference. What do we got here? Forecast. I'm not sure which number you're referencing for the Japanese yen. Yeah, I need more clarity for that. Let me see if I can dig into that one after the show, Larry, so I don't just stumble and drag my feet doing a live show with that one. But we can check that one out tomorrow. Let's see. Tomorrow, I'm not sure what is going to happen tomorrow. I had a twist. I actually thought that Justin Krebs is going to be on Tuesday. He's going to be on Wednesday. Of course, if you just saw the marketing piece that Justin put on his website, I thought that was pretty good. Basically, it's me and him going to duke it out on annuities. That will be Wednesday. I'm trying to get Bill Addis to jump onto Tuesday's show. If he is, he'll be my guest tomorrow. If not, I might work to the wee hours in the morning trying to put together my why Bitcoin will be $100,000 by 2023. But that'll take me a while to produce, so it might be a late night for me creating content for you guys. Oh, the wonderful life that I lead. So that will do it for me for today again. Thank you guys so much for joining us. If you have what's Salesforce about, that's database management, customers, like sales forms. right? Customer database management. It's probably the leader out there. Cloud-based database management. Basically, every new client makes them a ton of money because they already have all the infrastructure built in. It's web-based. They're pretty good. Okay, thanks, Larry. Tweet it out to me. Oh, wow. I did not. Exxon's getting kicked out of the Dow? Wow. Makes sense. A little bit late, but makes sense. All right, anybody, that will do it for me. I don't want to like Big Eb wins again. It's an hour show. Damn it. This 30-minute show is killing me. It's an hour now. All right, everybody. Thank you guys so much. Exxon sucks. Thank you guys so much. Give it a little thumbs up if you enjoyed it. If you didn't, please email me at TraderMerlin.com. You can go click that little fire button right there. Go to TraderMerlin.com. If you got issues with something I said or something I delivered or whatever, let me know so I can fix whatever might be wrong with the show. Or if you just hate me, send it in there as well. So comments down below the YouTube video. I do appreciate that. I will see you guys tomorrow. No clue yet. I may update here a little bit later on. I'll tweet out what the guest will be tomorrow. I'll see you guys tomorrow. Take care, everybody.